Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high-net-worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
All right, Adam. Welcome to Reston. You're at home base today.
Live in the flesh.
Love to have you here.
Episode 5.
Is it? Episode 5?
I'm going to say it's 5.
We got to start counting.
Sure.
Yeah, for sure. Well, so good to have you here. We need like a little bit more space in this recording studio that we have here in Reston.
Yeah.
But glad you're here because I think these things go even smoother in person. So what client questions do you have this week?
Let's talk about, there's a couple big things that came in the wire last week. One of them was regarding alternative investments making their way into essentially Main Street's 401k. This is something that I think has come up in its own little variation over the years, but now it's like the real deal and it's happening. So we're big, we've talked openly about alternative investments, but I guess what do you think about just anyone having access to these things in their retirement accounts?
I'm conflicted on it because as I think we've covered in the past, there's a lot of junk, high-fee junk out there in the alternative space. And so like the reason why you've got these accredited investor rules or these qualified purchaser rules that basically require you to have a certain level of wealth before you can access certain types of investments is really to protect people from the junk, the predatory junk that's out there. But on the flip side, you see a lot of really wealthy people, a lot of endowments, foundations, things like that, where they invest heavily in a lot of these alts. So, to me, it's almost like I get the protection angle, but also, if the big foundations and the high net worth people are investing in these, why couldn't Main Street people invest in these, right? These types of investments. So I'm a little conflicted about it. I think it'll be really crucial to see what the quality is of the investments that make it into 401ks.
Yeah, that's probably where the rubber meets the road for me. It's not the fact that it's accessible now to a broader pool of people. It's more along the lines of what does that pool look like in terms of investment selection. One of the main reasons, endowments and big institutions had advocated for alternatives for so long was accessibility and the idea that hey, we've got access to a certain opportunity set in the investment world that other people don't. It's this exclusive club, and with this club comes sexier investments and potentially higher returns.
Right.
We know that that's not always the case, but still it was able to segment off a portion of the investment population and give them special privileges. Now with this being opened up, it's kind of like the exclusivity goes away, and then you're just thinking, well, now what other investment players are going to come to the table and offer things to the general population that are more like they're really not that different than a generic stock and bond. They just have this higher cost alternative wrapper on it.
Right.
And are there enough investment opportunity sets to go around to kind of give that special risk return profile to everybody?
Well, that's the question, because you see people are being told that like these days so much of the small cap stock, previously a stock, IPO, they were a small company and they grew and they grew and they grew in public markets. But, these days people are at least being told that a lot of that opportunity is happening behind closed doors on the private side of the market, and they don't have access to it, right? So the question is like, to me is like, I think maybe there'll be sometimes it's this way, sometimes it's not, but like, is it those high quality firms that are growing on the private side that are being included in 401k plans? Or is it the people just looking to make a buck and sell the sexy investment when it's really just high fee, small growth public equity performance?
Yeah, well, I think that's the battle, even in the advisory space right now for us. It's like this battle between, our private firm, are larger investors now immune to alternatives and less excited about them, and they'd rather just go to the public markets to get a more predictable return stream, or has the private investment space widened and broadened so much that they're at scale and they say, hey, we need more investors to come in and help us piggyback on these really great investment opportunities. And I think, like anything, time will tell. For those people that are going to be looking at this as part of their 401k allocation, they've got to be really, really smart about cost. They've got to be smart about asset allocation, the risks they're taking. I'm worried that a lot of people are just like, they have it built in their brains that private investment equals excessive, above stock market like guaranteed returns. We know that's absolutely not the guaranteed case at all. There's a lot of risk and different characteristics that come with these investments, and I'm worried that the educational piece is not going to be there. I mean, any of you that have participated in a regular old 401k, you've got a menu of investment options, and you probably don't even know what's under the hood, and now you've got these alternatives on top of it. Like, it's getting more confusing and more opaque.
And I wonder what kind of guardrails there will be, if any, on these, right? Like with a private investment, it probably is not prudent to put an entire 401k allocation into private equity or private credit or something along those lines. So I wonder, like, I haven't read all the, I don't know if there's much detail about it out there, at all at this point. Maybe there will be more to come, but like, to me, that's a risk too, is people chasing and just over allocating to these things that are actually a lot riskier than they think. Because a lot of people don't realize that, like, part of the magic of private credit is that you just don't see the volatility.
Yeah.
Right? Because it's not mark to market daily, right? There, maybe there's a new price every month or every quarter or whatnot, right? And so you don't even necessarily know what your money's doing. It could be in a drawdown, it could be going up. Who knows? You don't see that volatility.
The price transparency is less. I mean, I think the big theme behind this is like, and I believe the most recent couple of public stock market sell-off and recoveries have hammered this home. It's like, we always heard about smart money, the street, Wall Street, the big institutions, that's the smart money. But I think it's the dumb money now. It seems to be the dumb money. If you look at institutional investor allocations to equity, especially during this most recent April sell-off, they've kind of sold on the way down and it's still waiting to get their allocation back.
401k investors they're the ones who stay the course.
Right, 401k investors. The retail investor, as they call it, has done a tremendous job staying in there. So this whole idea of alternatives and Wall Street's investments coming to your 401k, I think the tides of the smart money are turning, and you've seen a lot of big institutional investors. You've seen, we talked last episode about market forecasters and how they swing and miss all the time and adjust their price targets based on kind of sticking their finger in the
reactive,
huh? And this is just like maybe an additional play on all of that. So interesting to watch, but I'd say it's a kind of like one of the many innovations we continue to see in the investment world.
Yeah. There could be gains there, but certainly something to watch, and I'm sure we'll talk about it again as we move forward. Kind of on the retirement topic, I know we get another question about, so I retire, I'm used to the way taxes were, maybe I had a W-2 job, taxes came out of my paycheck, whatnot, now I retire, like, how do you even start to think about your retirement tax bill?
Yeah, I would say for most of our working years, the tax piece of our lives are a little bit on autopilot, especially if you're your typical, American employee in your W-2. You get taxes withheld for your paycheck. You might have some side investment income or other income where you have to make some estimated payments, but for the most part, taxes are withheld from your income streams, and then in April every year, you file and you get a refund or owe within a small margin of error. When you retire, almost the entirety of the tax planning burden is shifted back onto your plate, which is, I would say, a lot of people obsess over how much money I need to retire, what kind of a balance do I need to accumulate, but then the tax efficiency and the operational aspect of taxes in retirement kind of go by the wayside. But that's a huge transition, and there's a lot of nuances to it, so I think it's a really good question. Kind of your tax bill will depend on a handful of different things. that I'll highlight. Number one, and this is the most important, but looking at your resources, bucket them out. Hey, how much pre-tax money do I have in IRAs, 401ks? How much Roth money do I have? How much taxable money do I have in brokerage accounts? And what percentage of each of these buckets do I have in relation to my total net worth? And I think for most people, a majority of their retirement savings is in pre-tax retirement accounts, which has its own unique planning complexities. But the distribution across those different buckets by tax type has a huge impact on the amount of flexibility you'll have in retirement. So that's the first piece. Okay, what do I have and what's the tax treatment of these different buckets of money? And then based on what I need to spend for my portfolio, where should that come from?
Right.
And when? And the where and when is really driven by when you're taking other income streams like Social Security. Will my spending change over time? Am I going to go, crazy with a lot of travel early on and need to take bigger distributions and then level off, or some other variation of that?
Sure, RMDs come into play.
RMD, the timing of minimum distribution. So it's really this battle of flexibility, and also just your circumstances and where you need to spend from. But generally, when you take distributions from your taxable investment accounts, you'll pay capital gains, short-term or long-term, based on what's under the hood of your portfolio.
So capital gains are interesting, right? Because there's actually 3 different tax rates, right?
Correct.
There's the 0%, the 15%, and the 20%, right? And I know there's the net investment income tax that comes into play at higher dollar values as well. But I think that's something that people miss a lot of the time.
Yeah, well, actually, when you layer on that net investment income tax, there's actually an 18% bracket.
Okay,
also.
true.
So it's really 0, 15, 18 and change, 20, 23.8.
Right.
So there's several different capital gains tax brackets. How much in terms of gains you realize each year is really significant from a planning standpoint. You can't, let's say you've got an investment account at Charles Schwab or Fidelity or Vanguard, you can't have taxes withheld from capital gains.
Right.
Right, when you sell something at a gain,
Yeah.
you can't have
That's a fun surprise, right? If you're not used to paying estimated taxes.
Right, you need to factor those gains
you pulled
into
all
your
this money
estimated
out.
payment.
It's wow, why do I owe so much money?
Yeah, you need to factor in those gains to your estimated payments. That's a big one. And then secondly, if you take a distribution from a pre-tax retirement account, you have the option to have taxes withheld. But again, it's hard to know, especially when you're in transition from work to retirement. A lot of people are sitting there thinking, well, what's my tax bracket? Right? I mean, what I've earned a salary, I kind of knew where my tax bracket landed. Now I'm living off the portfolio. I'm taking a retirement distribution. What do I think my annual income's going to be, right? These are all very complicated decisions. And I would say in general, when you make that transition into retirement, most people are surprised, though, that their tax rate ends up being a little lower than what it was during their working years.
Why do you think that is?
Well, I'm going to speak from experience working with clients, because if you have only pre-tax retirement funds, you might be at more of a risk of kind of falling into that higher tax bracket.
Sure.
Right,
because that's taxed at ordinary income rates.
Right, and if you want $10,000 from a pre-tax IRA, you're not going to get, you can't just take $10,000 out, right? You can, but you need to gross that up essentially for taxes. So it might be 12 or 13,000 to come out to give you your 10. But I think in general, people have that flexibility in their different buckets. If they've got brokerage accounts, pre-tax, Roth, maybe HSA funds, they have more, from a planning standpoint, we have more of an ability to help them plan out, okay, you need $10,000 a month from your portfolio. Here's how much should come from each bucket and when. So it becomes a little bit like a puzzle that changes every year.
Yeah.
And as things like Social Security are coming into play, required minimum distributions, as your spending level changes, all of those variables are adjusting alongside.
How does someone even stay on top of all this?
Planning, right? It's transparency and planning. It's always, I'd say, don't leave it to chance. Take dedicated points in time during the year, whether you want to line it up to each quarter or twice a year or, different intervals, just sit down, take inventory of what you've taken out from where, and then run it. We run tax projections and kind of seeing where you are.
I've got some clients who are like engineer background types.
Yeah.
And they, I think for fun, build spreadsheets, trying to project all this stuff.
Well, God bless them. That's a heck of a, I'd see as an engineer, that would be really exciting. But I think it's exciting, and I think a lot of people here think it's exciting, but it's just I think there's a few things, just to kind of round this up, a few things kind of catch people by surprise in this whole taxes and retirement planning process. Number one, it's the idea of not being on autopilot. So it's very possible that for year one, it might make sense to pull all of your retirement income stream from one type of account, and then the next year to totally flip that switch based on circumstances. So that's number one, just the idea that this is not a linear process. The tax code's changing. Look at this year with OB3, things are changing.
Is that the name, by the way? OB3?
I like
what we're going with? OB3?
It's OB3.
R2D2 and OB3?
It sounds more prestigious. And then the non-linear aspect of this, and then also using taxes, using your tax situation in retirement as a lever you can pull to open up other planning strategies.
Okay, I was going to ask about that.
Use it to your advantage. Don't just, worry about paying your tax bill, but use this whole idea of flexibility in taxes in retirement. Hey, I'm not just getting a paycheck that's taxed this one way. I've got various different types of income streams taxed in different ways. Let me use this as an opportunity to explore planning opportunities.
So what kind of tax strategies though? Get a little bit more specific on that. What kind of tax strategies do you see people using in retirement?
Yeah, a few. Number one, the whole idea of finally being able to convert money from pre-tax into Roth. Most of us go on autopilot saving for retirement and build up a ton of pre-tax money in 401k specifically. So I was talking earlier about flexibility and different types of buckets that you can draw from. I'd say most retirees have an overwhelming percentage of their wealth in pre-tax, which is fine until you start paying your taxes, and then you run up into things like needing to gross up distributions or take more out and pay taxes to get the same paycheck, or also your RMDs, your minimum distributions on those accounts, end up being significant in size.
Sure.
So early on in retirement, if you have some flexibility to delay drawing big sums out of pre-tax accounts and can draw from a cash account or a brokerage account, your tax bracket then might be incredibly low, and then you can use that kind of room you bought to convert money to Roth.
It's tax arbitrage, basically.
Essentially,
you've got
a nice investment person would say.
Exactly. I learned that in the CFA program.
Yeah.
So basically, to explain that a little bit, is you've got lower tax brackets that if you're in a low tax year, you're not really using. But let's just say you're at RMD age, which what even is RMD age this year? They keep changing it on me. It's hard for me to keep up.
Yeah,
74, something like that. Let's say
people are 73 now.
You're required to take RMDs, right? Now all of a sudden you've got these big distributions that you're forced to take that push you into those higher tax brackets. So what you're essentially doing is you're trying to avoid that scenario by taking advantage of these lower tax. So you're paying the tax now to get it into a Roth IRA where it grows tax free. But you're paying a lower tax bracket than you otherwise might later on.
You are. For example, if you can, let's say someone retires at, 62, they're not taking Social Security yet, but they have a, brokerage account that they can live off of for the first 2 to 3 years of retirement. You are smart about how you invest inside that account. not take too many, realized gains. But you draw your income stream from there, and now you're in a situation where you're like in a maybe 10%, 12% tax bracket comfortably, especially now with all the nice, new deductions we have to manage around. You will probably at that point have significant room to convert money from pre-tax to Roth. So you're right. You're if you've got the opportunity to prepay a tax bill at 10 or 12% at the federal level, I would say most people would want to take that deal.
Yeah, that's not even accounting for the tax-free growth that you get. We talked about a lot last episode about how long you might have in retirement.
Right.
And so if you get that money in a Roth and it grows for decades, that's tax-free growth. Even if you don't tap into it, now your heirs
will have 10 years.
Get a great tax-free sort of experience as well.
Yeah, absolutely. So that's the kind of stuff you need to weigh, especially in light of, the type of, what amounts you hold in each of these different tax buckets. But I think that's the big one. It's, making that decision around when I want to pay my taxes on certain income streams.
It's funny to think about taxes as like something that's flexible. Because for most of us who work, right, there's like no flexibility, right? I get paid a W-2 wage, right?
That's withheld,
and I pay taxes on it, right?
The IRS, they don't let you, kind of, in most cases, they don't let you hang on to your money, any longer than they want you to. This is a way to do that. So I'd say, planning ahead for those windows of time where your income might be really low is really important.
I know it can be challenging enough to set up a 401k and pick the right investments and all that stuff. And, that's a skill. And this is like a skill, this tax planning skill that we absolutely don't hone until we retire.
Until you're out the door. And the other thing is, for clients that are charitably inclined, there's another layer even on top of this. So let's say you're someone who normally gives $5,000 a year to charity. I'm throwing a number out there. It could be any, up or down. Let's say you normally give $5,000 a year to charity while you're working. You want to continue to do that in retirement. It might make a lot of sense to kind of start to pair some of these transactions together. For example, instead of giving $5,000 a year for the next 10 years, you give $50,000 in 1 year. And then you layer that with a Roth conversion, right? A larger Roth conversion that would normally cost you more from a tax standpoint in a given year. But you're going to do this Roth conversion in year one in retirement, along with a bigger donor advised fund, or gift to charity of appreciated stock or cash, whatever it is. So now you've offset the cost of a big Roth conversion with a charitable gift that you would have made anyways.
Right,
over time.
You're just front-loading it now.
You're front-loading that tax-free growth. And that's the kind of stuff where, in some cases it works, in some cases the math might not be as favorable, but these are the things you should be thinking about.
Yeah. Wow, a lot to think about in retirement, right? It's more than just which vacation I'm going to go on and which...
this is the fun stuff. Yeah. And then you get new tax bills to layer on.
You find this the fun stuff.
Unless you get a new tax bill to layer on top of all this.
Yeah.
But what in general, we just hit this massive, kind of midway point of the year in the markets. What are some of the things that get you most excited about the second half of this year?
Ooh, about the second half of this year?
Just in general.
Just in general, investing-wise.
Yeah, what are some of the things that are interesting themes to think about for the next 6 months or so?
Well, the first thing that comes to mind for me is the AI trade is back. This is something that has ebbed and flowed all year long, and part of it was due to the tariffs thing. But I'm excited about, that and kind of the opportunity that comes with it. I think that it's a bit surprising, I think, to people, because it's not just the big names. It's not just your NVIDIAs. It's not just Meta, right? There's all sorts of companies within the ecosystem, all the way down to utilities companies, right, that are generating new electricity, that are seeing some positive momentum. So I think there's a lot of interesting stuff happening there. From an investment standpoint, and I can't wait until we can stop talking about tariffs.
Yeah,
I just it seems like every
tariff
day.
Game over after this past weekend. Are tariffs over?
Are tariffs? Well, apparently they've been set at a specific level, and they'll be that way. I just to me, tariffs are here to stay for at least, the next, 3-4 years, whatever that may be, until a new administration comes in, and it could be from either side of the fence here, and decides whether or not they like tariffs. But at least there's certainty. That's what the market was looking for, is certainty with regards to tariffs, and it's not this worst case scenario. I think we talked last episode or the episode before about how really the tariff story has gone away. It's not really something that's affecting the markets these days. So it still has a modest impact, but we're not going back to Liberation Day.
Yeah, I think everyone got fatigued on the tariff side, us included, and we kind of hit a point that everyone feels comfortable with to move on. Yeah. And I got a question earlier today about, well, why didn't the market react more strongly?
Yeah.
When
so that's a great point, and then the reason is the market's already reacted.
Right.
That's
news. What the recovery was.
Yeah.
The past couple of months.
Yeah, the market's had time to digest it. Like, this is something that I think, just so easy. Whatever the last battle was, that's what we look for, right? And we're like, okay, tariffs were bad. So we got to watch out for tariffs. Inflation was bad. We got to watch out for inflation. A pandemic was bad. We got to watch out for every virus, right? And in reality, the market reacted strongly to the news, priced all that in, and then moved on and is looking forward. So I think the thing, if you're looking for something to be concerned about, you might as well look to left field, because we have no idea what that thing might be.
Yeah, that's an interesting theme to watch for the next half of the year. And yields. I'm all about yields now.
You're gonna get me going again, aren't you?
People have been not dividends, but cash yields.
Okay.
People now are, I think it's just, you're seeing it now in fixed income. People are earning, they're clipping a reasonable yield on their safer investments. High yield money markets are still paying close to 4%.
Yeah.
Although that's changing a little bit by the day, but
right.
From an asset allocation standpoint, I think there's a really big wealth effect from people in fixed income and these safer assets finally clipping a yield.
What happened in 2022, where the Fed raised interest rates so aggressively and it tanked the value of fixed income, I mean, that's so atypical, right? That's not the base case. That's not the norm for fixed income. And the silver lining of that big move is today you're cashing in on those higher yields, right? So I would make the point that you might want to think about tax efficiency with this. So muni bonds and taxable accounts, put higher yielding investments in those tax deferred retirement accounts we talked about earlier, right? Just from optimizing for after tax returns. But yes, it's nice to see people are finally getting those yields. Because it was my entire career. The whole storyline was bonds don't pay anything.
Yeah, zero. Well, we got some great questions this week, and keep them rolling in. Our email is longstoryshort@Burney.com.
Thanks, everyone.
This podcast featured Adam Newman and Amy Pratt of Burney Wealth Management, which is a division of the Burney Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long Story Short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational and educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who is familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Burney Company is an SEC-registered investment advisor. Registration with the SEC or any state securities authority does not apply to the Burney Company or any of its principals or employees, possesses a particular level of skill or training in the investment advisory business or any other business. Burney Company does not provide legal, tax, or accounting advice, but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.